information in IRA versus Roth IRA, and some of this is probably information that you know already, but consider it a review and think of people who, and even yourself in terms of your own planning, using the annuity for financial planning as we go through this. Well, Mr. Tie-Dye is on.
Hello. All right. Let us start. I had emailed everybody the training agenda, and let me share my screen with you guys. There's a couple of things that I will like to talk to you about before we move forward with Tom's presentation. Just a second. Okay, off we go. I hope you are able to see us and see the presentation as well. We would ask if you could mute yourself if possible. That would be very helpful, that we will not hear the static. We have a great news, right, Tom?
Yes.
Annuity promotion was extended. We're very excited about it. We kind of wanted to have this done and that promotion extended, ladies and gentlemen. And we have it till May 17 of 2021. As you know, the tax deadline was also extended. That is why we had extended our promotion. Very popular. Lifetime annuity with 5 year single premium surrender, and the first year 2.75, remaining 4 years 2.5%. Someone is not muted. Just a second. Ladies and gentlemen, I don't know why we hearing this static. Okay. All right. Sorry, I jumped ahead of myself. That means annuity promotion is in. Any questions? Any questions about our promotions? We had received our quarter that closed March 31st. We were doing a wonderful with annuities. We were doing a wonderful, a lot of annuities that we opened because of this great promotion. A lot of people are interested because the banks are offering like 0.05, which means 2.75 really sounds wonderful, wonderful, or 2.5%. That means do not delay. We need those application by May 17th, May 17th. As you see, we have 3 different plans of, in respect to annuities. We have the 5-year single premium. It's a lifetime annuity. I want to stress this out. The lifetime is just the rate there is guaranteed for 5 years. We have an 8-year. The rate is guaranteed for 1 year, 2.5%, and then after that it could change. And also we have a 2-year, ladies and gentlemen. You probably not hear that much about this plan because there is no commission to agents. There's no commission to agents. That's why we do have it available, but you as agents are not going to receive commission for that sale. And spring into summer, yes, that agent contest is in a full swing. Tom had and we send out some names of our agents that are already are entering the contest. As you see on your screen, you have our agents that submitted applications from first day of spring. And you have the totals also. We have some other agents that also submitted application as well. Congratulations. We're keeping all the reports organized, and we will be sending those monetary winnings to the agents that are hitting those benchmarks. The other thing that I would like to mention, we have that little brochure. As I don't know if you had joined at our last meeting when Tom was explaining how important the brochure is, that shows our strength and stability, the independent competitive report. It is available. We have received it. We have it available. If you would like to have one in your folder, please let me know, and then we're going to definitely mail it to you. We also have a scan version of as well too. This is really good for us to provide it to our clients and provide information on stability of the PNA. Tom had asked me to do a little bit of research on a free Zoom account. I know that some of you said, oh, I cannot meet with my clients because of they don't want to meet with me because of COVID. There is a free Zoom account that we as agent could set up for us. If you just type in Google Zoom free account, you will be able to sign in. You have to enter your email and then input your birthday. And then you will receive actually an email verification that you will be able to get that account going for you. Because it is free, that means you are limited on time. You have up to 40 minutes for the meeting. This is the limit for that free account. This is something that that is available. And if you're interested and you would like me to help you with it, please do not hesitate. I'll be more than happy to do so. I know that Tom has.
The Zoom account, it's a great way to keep in touch with your family members, the kids, the grandkids. And it is free. We did that. My wife is from a family of 8 kids. And they used to have a Sunday evening meeting once a month, and they would use Zoom, and it was free for 40 minutes, but they found that they couldn't limit their conversation to 40 minutes. So we actually had to sign up for a real live Zoom account. But on the free one, you can, and it's not very expensive. I think it's like $20 a month to get an account. But on the free one, you get the 40 minutes. You can have a number of different participants, and it's unlimited. You can use it all month long, and it's not limited to how many people that you can use it with. So it's a nice tool, and it's very simple to use. And I highly recommend it.
All right. I am very excited about this slide. Very, very.
This is her excited face.
Yes, I am very excited. I am very, very excited. And this is also available to you, ladies and gentlemen. Tom had set up through a fraternal insurance counselor's course of studies that are available to us, to the agents. And I would like Tom to take over now.
Okay. Fraternal insurance counselor, that's the FIC designation. And the organization is the National Association of Fraternal Insurance Counselors. And that's the overseer organization of that is the Fraternal Field Managers Association. And they award the designation. There's 4 courses that you go through for the FIC designation. The first one is ethics. Then there's a life insurance course, a needs analysis course, and then an advanced markets course. And what we're proposing is that we will do the courses online on a Zoom class, and just go through each course as we can on a weekly basis, have a meeting, go through all of the chapters of the books, and then make room for the final test, and we'll get this all done together. So anybody who would like to sign up for it, we're putting out a notice later, this week, or
Yes, right.
which leaves today or tomorrow. But so you'll get some more information on how to sign up and what the scope is. So and then we'll set up an agenda in terms of classes. But I highly recommend it. It's good information, and it's information that's really kind of directed toward the fraternal insurance agent. So it's good stuff.
And also, it's going to count towards our continuing education.
Yes, in I think almost all states it counts towards your continuing ed.
Which I need. All right. Like we said, we will be providing more details. Okay, and my computer decided to, just a minute, ladies and gentlemen. All right. Now, I'm turning over to Tom, but before I do so, there's one more thing that I want to mention. Alicia is working on a newsletter, and if you have anything that you want to include in the newsletter magazine, get ready for that, because I know she's starting to work on that newsletter, right? Tom,
yes.
Now it's all yours.
Okay, thank you. Going to move into the driver's seat here.
Yes.
Well, welcome again, everybody. What happened?
No, because we are in the other. Yes, there you go. Thank you. Sorry about that.
Thank you. Okay, so we're going to go over some Social Security information, non-qualified annuities. Then we're going to talk about Roth versus the traditional IRAs, and there's a lot of information in here. So if you have a question, make sure that you ask, and we will, like I said, there is a lot of information, so just kind of bear with me. But we'll go over Social Security and facts you need to know. So talk about sources of retirement income. And Social Security, it provides a real nice base of retirement income. But when we talk about it, average retired worker in 2021 receives an estimated $1,543 monthly benefit. And that's about 40% of the average pre-retirement income. So that's quite a drop in what people are actually experiencing. And it could come with a reduction in lifestyle. So when you talk about 40% of average pre-retirement income, $1,500 a month being about $18,000, the person was making about $45,000 before they retired, and it drops to $1,500 for Social Security monthly payment. So that's quite a drop. Another source is employer-sponsored plans, IRAs. And the employer-sponsored plans are really not what they used to be. A lot of them used to be a defined benefit pension plan, or even a current contribution pension plan, but the defined contribution or defined benefit plan. And a lot of companies have gone over to the 401k at this point. So there's some risk involved with a 401k, although Some 401ks now let you have an annuity, which takes some of the risk out of the 401k. The final source of retirement income is home ownership and personal retirement savings. And a lot of people have depended on the fact that their home is going to increase in value. And yeah, sometimes that happens and sometimes it doesn't, but also sometimes they need to take a loan on their home, whether it's for their kids' education or something else that comes up, medical costs. So sometimes they don't have the money that they thought they were going to have in their home equity. And then there's personal retirement savings, and that's kind of what we're talking about, is taking hold of our own futures. So the question is, if sufficient retirement income is not available, will you have to defer your retirement age? In other words, will you retire at a later age and keep working beyond when you thought you were going to? Or will you choose to reduce your standard of living? And let's not have to answer that question. Let's make our incomes where they need to be. So important facts. Social Security normal retirement age is currently 66 for people born between 43 and 54. It's going to age 67. And I remember when I started in the insurance business, we always talked about age 65 is when you were going to retire. Now it's up to age 67. And a lot of people wait till later than that. If you retire early, and you can retire as early as age 62, but your benefit is reduced by almost 30% if you do that. What happens if you don't have enough money to be able to retire when you want to? According to the Social Security Administration, the maximum Social Security is $3,148 a month, and that's about $36,000. So that's some people can live on that. Most people can't. The average is $1,543. We already saw that number earlier, and that's about $18,000. So Social Security spousal retirement benefit. In other words, my wife and I both get Social Security because we both work. Mine is higher than hers, and let's say it's about let's say mine is $2,000 a month and hers is $900 a month. So it's $2,900, almost $3,000. If something happens to me and I'm no longer around to collect my Social Security, it goes down to half of what mine was. So I was doing 2,000. It goes down to 1,000. She was doing 900, and she loses that because she can't collect she can't collect her own and Social Security from a person who's deceased. So she gets half of mine. So her income goes from $2,900 a month to $1,000 a month. And that's something a lot of people don't realize that. And that's not an easy thing to deal with. And if the spouse retired early, that's what the other spouse gets half of. So, and again, these are things that people aren't really aware of. So how much do you want to rely on a source of retirement income over which you have no control? There's kind of a neat quote here from Time Magazine. For government to pay pensions to the advancing tide of baby boomers, of which I am one, will almost certainly require stunning benefit reductions or huge tax increases, most likely both. After years of fiscal and political fecklessness and an explosive conclusion. So when was that article written? 1995. So here we are, and that statement still applies today, unfortunately. So when we talk about putting money away, here we are, somebody, if $100 a month is saved, what's it worth at age 65, assuming 5% annual return? And if you start at age 20, putting $100 a month away, you'll have $196,000 at age 65. And as you can see, the longer you wait, the less money you're going to have at age 65. I kind of like to, Albert Einstein said the eighth wonder of the world is compound interest. I used to use a visual when I was selling insurance and telling people to save money. And I would draw a triangle. And I would put ages down here, age 25, 35, 45, 55, and 65. And this up here is a retirement goal. And what you're doing is you're kind of like pushing a boulder up the hill. And if you start out here, okay, that's your angle that you got to push it up. But if you start back here, it's really hard to push that thing up the hill. And I used to use a circle for the boulder, but I could not draw the end. I'm not that much of an artist. But, and this, everybody, when they looked at this visual, says, "Oh yeah, I see what you mean. I need to do something." And we do need to do something. This is something that's always included in these PowerPoints. Years to age 65 over here, 40 years to age 65. So this person is 25. If they're making $50,000 a year by age 65, they're going to have $2 million. The question is, how much of this money will be available to you for retirement? How can you systematically accumulate that money? And how can you guarantee a retirement income that you can't outlive? Well, yeah, you guessed it. The answer to that is an annuity. And again, we're talking here about non-qualified annuities. So I'm not talking about an IRA or a Roth IRA. I'm just talking about a regular annuity. And the difference between life insurance and an annuity is life insurance provides protection against dying too soon. An annuity protects against living too long and being without the income during retirement. And what are the annuity objectives? Well, really, there's two things that annuities do. You can accumulate money with an annuity, and the big word there is, well, it's actually two words. It's hyphenated, tax deferred, when you accumulate money in an annuity. Every time the value of your annuity goes up, you do not pay income tax on that increase. And so that's the tax deferred part. And that helps with growth. And I'm going to be talking about this all the way through this presentation because the tax deferral is a real big part of an annuity. Then you have a distribution phase. And what we're looking at here is lifetime income with an annuity that you can't outlive. So when it says lifetime, it means just that. You'll get an income all of your life. There's single premium immediate annuities, there's immediate income annuities, and then in the policy itself, there are income options. And when you exercise those income options, they call that a supplementary contract. So annuities are classified in a number of different ways. First of all, when the annuity payments begin, how the premiums are paid, and then how the annuity premiums are invested. And when the annuity payment begins, we talk about deferred annuities. So the deferred annuity is the accumulation part. So you have a savings or income phase. And during that phase, there's a deferral of taxes on the annuity earnings. And that is a major advantage that other non-qualified financial products cannot provide, like a mutual fund or a CD or other things that you might use to accumulate money. So the tax deferral of the increase in the annuity earnings is a huge, huge advantage. On the annuity starting date, you go into the income phase. So you've accumulated money here, then you get to the point where you're going to retire and you have an income phase. So that's a deferred annuity. Immediate annuities, you go right into the income phase right away. So it would be like giving PNA a large sum of money, maybe $50,000, $60,000, and taking an immediate income from that. Okay, how the premiums are paid. What we refer to right now as our 8-year annuity is a flexible premium annuity, which means that it's an installment premium annuity. The premiums are fixed or flexible, and during the accumulation or savings period, they accumulate on a tax-deferred basis. And on the annuity starting date, the value of the annuity can be converted into a stream of income. Okay, on the single premium annuity, you can have a single premium deferred annuity. I get rid of a CD, or I sell my house and I have a large sum of money. I'm not ready to retire yet, so I don't want an income stream. So I put it into a single premium deferred annuity. That's what our 5-year annuity is. That also accumulates money, and it is also tax advantaged. The single premium less any charges is converted into a stream of income immediately when you decide to retire. Okay, then there's how the premiums are invested. And that we talk about the annuity having a fixed rate of interest. There are variable annuities, there are indexed annuities. Our particular annuity, the PNA annuity, is a fixed rate annuity. And it has a minimum interest rate of, currently the minimum interest rate is 1%. But there's also a current interest rate. Our minimum interest rate is 1%, and the current is 2.5%. And then we have the promotion on the 5-year surrender charge annuity, the single premium annuity of 2.75 the first year. And then the 2.5% is guaranteed for the next 4 years after that. So that is how the premiums are invested. We have, we declare the interest rate every 3 months. And on the 8-year annuity, the flexible premium annuity, the first year is guaranteed, but after that, it's a current rate. On the 5-year, it's 5 years is guaranteed, and then it's a current rate after that. The current rate is set by our executive committee on a quarterly basis. And they try to keep it as stable as possible because first of all, we're a membership company or fraternal. We're a membership fraternal. And the other thing is that we want to make sure that people feel comfortable with putting their money with us. So, and how we declare that interest rate is based on how well we're doing with our money. So it amounts to like a big mutual fund. And I hate to say that because it's not a mutual fund, but insurance companies invest their money in a lot of different things similar to a mutual fund, but and it is very conservative and it's very stable. So when you buy into a annuity with a fraternal insurance company, it's like a mutual company, and so you're spreading your money around in a big way in terms of risk. So they sit down and they decide what the interest rate is going to be, and then that's the interest rate that is declared, and that's the interest rate that is published. So, and that is how they come about with an interest rate. Deferred fixed interest annuities, and that's what we're talking about, can be purchased with a single premium or with installment premiums. You have the rate of interest during the accumulation phase, and then you have an income phase or an annuity starting date. And there's a lot of different income options that you have at that point, and we'll go through those in a few minutes, but you can have an income that you cannot outlive, and that is such an advantage to the annuity. Immediate fixed annuities can be purchased with a single premium only, and then it only has an income phase. There's no accumulation phase to that. And it has the same types of incomes options as the other annuities. Let's talk about suitability for a moment. And this is a tough subject these days. Because agents sell annuities, and there's also what's called a fiduciary, and fiduciaries sell securities. And excuse me, the fiduciaries have now have the responsibility of making sure that the best interest of the client is in mind. Agents, when they're selling annuities, are concerned with suitability to make sure that it's a good fit for the person. The product that you're selling is a good fit. The best interest is just a little bit of a higher degree of responsibility in terms of making sure that the client has the right product. But there's a lot of talk about best interest and suitability right now. When agents submit an application for an annuity, they also have to submit a suitability form. And we review that to make sure that everything is copacetic and that it's the right fit for the client. So who's best suited for fixed interest annuities? Well, it's people who prefer to rely on fixed rates of return. They know what they got and they know what's coming. Focus on preservation of assets. They don't want a lot of risk. They want protection from market volatility. And they prefer to delegate investment decisions and risks to the insurance company. And as I said, when we declare an interest rate, it depends upon how well we've done with our money. And we have people that we use to invest in our assets. It's also people who understand that a fixed rate of return may not provide a hedge against inflation. So if you lock in an interest rate for a period of time, any kind of a product, a financial product, and inflation starts to go up, you may be just a little bit behind. We haven't had a problem with inflation for a long time, but I'm sure there's some of you that can remember what it was like back in it would have been the late 70s, early 80s. Inflation was pretty interesting. So the annuity income phase, the person gets out, they've been putting money into their annuity, or they had a single premium annuity that they put in at age 35 and they get out to age 65 or 70 whenever they want to retire. They can have a lump sum distribution. But there's also systematic withdrawals, and there are annuitization options that they can do. You have to be a little bit careful about a lump sum distribution because it may be subject to a 10% federal tax penalty, but there's also on any kind of gain on a lump sum distribution, if there's gain, you're going to pay income tax on that gain in the year that you take the money out. So let's talk a little bit about annuitizations. And these are the PNA annuity income options. And these options are in the policy, so they're contractual. They're in the policy itself. So option one is a full cash refund annuity. And what happens is the monthly payment is set up and it'll be made as long as the payee is alive. You can't outlive it. At death, PNA will pay to the beneficiary anything that's left over if the full premium has not been paid out. So the person may live to the point where, okay, $35,000 has been paid to that person, but they put $50,000 into it. The other $20,000 would be paid to the beneficiary. If they live beyond where that $50,000 goes, if they live to age 100 and that whole $50,000 has been paid off, when they die, there's no other payment due to anybody. So option 2 is a life annuity. Monthly payments are made as long as the annuitant is alive. No other payment is available to anybody. So the person gives us $50,000. They live to age 100. We'll make monthly payments all the way out to age 100. But if they live 10 years, there's still no payment to anyone. So you had a comment earlier.
Yeah, there was a agent in New York that was kind of, I guess, gambling, I would say, with his mom annuity. And he said, you know, she's Polish, she's going to outlive the calculations, and she did. And he was actually with the company that he's in. He said that they always pointing out that he kind of picked the best plan for his mom, and he like predicted, because actually they're still paying that annuity because mom is still alive.
Okay, we'll come back to that in just one second. Option 3 is a life annuity with 10 or 20 years period certain. What that means is the monthly payments are set up and they're made, and they will be for lifetime, but there's a specified period of 10 or 20 years. And if, for instance, the person dies after 5 years, another 5 years will be paid. Or if they have the 20 year, if they've lived 5 years, another 15 years will be paid to the beneficiary. So it's a life annuity with 10 or 20 year periods certain. And all of these options have different amounts of monthly payments. So option 4 being a joint life annuity, payments will be made during the joint lifetimes of 2 payees. It could be a husband and wife. And after the death of one payee during the lifetime of the surviving payee. The amount of monthly payment is determined by the ages of the payees on the date the supplementary contract is effective. So they average out the age of the 2 people and then determine what the monthly payment will be. The monthly payment will go to both of them and to one of them if one of the people should pass away. So the question is, which option pays the least amount of monthly income? Well, the joint and survivor would, because you're taking 2 lives into account. The life annuity for 20 years, because you're guaranteeing 20 years of payment. The 10 years, you're guaranteeing 10 years. The full cash refund, you're guaranteeing, the insurance company is guaranteeing that all the money is going to be paid out one way or another. The life annuity has the highest monthly income because if the person takes a monthly income and then dies, the insurance company keeps whatever money is left over. So why would anybody do this? Like Yola said, they're gambling. They think that they're going to live longer than what their initial amount of money was that they put into the annuity was. So, okay. Taxation. During the accumulation phase, earnings credited on the deferred annuity are tax deferred. Okay, I told you I was going to say this a lot, but it's a huge advantage. If you withdraw money from the deferred annuity, first of all, anything above what you put in, what you put in is your cost basis, and then anything above that is gain. And if you withdraw any amount of money, that you're going to pay income tax on whatever the gain is at that point. In addition, if you're less than 60 years old, there's a 10% penalty tax. So if the annuitant dies during the accumulation phase, the value of the deferred annuity is generally included in the annuitant's estate to the extent of the deceased annuitant's premium that they pay. Okay. Just trying to think if there's anything else. Okay. During the income phase, in other words, this is the distribution part of the non-qualified annuity, the annuity cost basis is returned in equal income tax-free amounts over the expected payment period. So again, there's what's called a ratio, an annuity ratio. And this is another advantage because you can spread out your income tax over a period of time. What they do is they take the amount of money that you have in your annuity that you've built up over a period of time. So part of that is cost basis, part of that is your gain. And there's a ratio. It might be 80-20, it might be 70-30. So when you start getting your monthly payment, 70% of your payment is tax-free, 30% is taxable, because 70% represents what your cost basis was, 30% represents what your gain was. So it's a way of spreading out that income tax cost. So here again, it says a portion of each payment in excess of the tax-free return is taxable in the year received. In summary, a portion of each annuity payment is received income tax-free, and the balance is taxable as received, and it spreads out the taxable consequences. Again, at the annuitant's death, the present value of any remaining annuity due is generally included in the estate to the extent of the deceased annuity's proportional contribution to the purchase price. So, okay, so advantages. Earnings on your annuity premiums are tax deferred. Okay. It offers the potential for accumulating significantly higher amounts of money over time. Annuity can be used as a source of retirement income that you cannot outlive. Unlike an IRA or maybe a pension type of plan, there's no annual contribution limits to an annuity, non-qualified annuity. Subject to the terms of the contract, there's no required date that you have to start taking income payments. You have the flexibility to defer them. If you die while your annuity still has value, the annuity death benefit passes to your beneficiary without probate. That's a big deal. Okay, as long as you have a named beneficiary, that money is going to go to that beneficiary. And then that's another thing that you need to be careful about is you don't want that money going into your estate because then it does get probated. So if you have a named beneficiary, it'll go to that beneficiary without probate. In most states, an annuity is free from the claims of a creditor. So the creditors can't get to it. And that's called the Homestead Act. You don't want to Google that. Disadvantages, premiums for non-qualified annuity are not tax deductible. It's not necessarily a disadvantage. There may be a surrender charge. If you take it out, take money out before the surrender charges are over. If a withdrawal is made prior to 59.5, you may have the 10% federal penalty tax. And when received, investment gains are subject to ordinary income tax, not capital gains tax. So then we talk about insurance company ratings. And the financial strength of and the claims paying ability of the insurance company is really important. And I'll show you, Yola mentioned the standard analytical independent report before, and I'm going to show you that in just a moment again. Annuity features, in the case of fixed interest annuities, the current interest rate being credited, how often does it change, and what is the minimum interest rate guaranteed by the contract? Take a look at withdrawal and surrender options and make sure that those are available. Take a look at how the death benefit is determined and the income payment options available. So now, again, back to this independent comparative report. Down at the bottom, it says, based on the financial results achieved in the year ended 2020, the company analysis, what's it say? Thanks. The comparative analysis made of the organization featured, which is PNA, is favorable when compared to the aggregate averages of 25 of the leading life insurance companies. I remember showing one of these to my mom one time when I used to work for another fraternal insurance company. And we had the same report, and I gave that report to my mom, and she looked at it, and she said, "It's nice to see how you guys stack up against the big guys." And when you look at the names of those insurance companies, you have Allstate, you have Guardian, John Hancock, Lincoln, Mass Mutual, Metropolitan, Northwestern Mutual, a lot of big insurance companies, and we do stack up very, very nicely to those companies. So I would recommend that you keep one of these reports with you and use it because it's a little report, but it has some, it's very, very powerful. Okay. So what's in it for me? Why purchase an annuity from PNA? Well, you've reached the age when you're no longer accumulating assets. You're now using the assets you've accumulated to provide retirement income. So you've gone past the accumulation phase and into the distribution phase. You've done well with your money in the equity markets, and now you want to protect what you've earned, okay? You've seen, I don't know if you watched our earnings on the Dow, my goodness, it's been up and down and up and down and up and down, and it's enough to make you crazy. But it's recovered since the pandemic, but it's still going up and down. And once you accumulate money for your retirement, you don't want that happening anymore. You want to protect it. An annuity is a really good way to protect it because of the stability of the interest rates. Tax-deferred buildup is a valuable characteristic of the annuity product, and tax advantage distribution is also beneficial. And we talked about the annuity ratio when you start taking money out on a monthly basis. Annuities are an insurance product, and as such can guarantee an income stream that you cannot outlive. And I can't stress that enough. That is financial peace of mind if you know you're going to get that check every month, not have to worry about it. So, any questions so far?
I will actually like to give you an example. This was like one of my first sales of annuity. I had a gentleman. He has a very successful business, and he says, "Jolanta, I have $100,000 of my savings. You know, if I keep those savings at the bank, I'll be receiving a 1099 interest every year, and I'll have to pay taxes on the amount that I had earned. And my business is doing very well. You know, I'm paying so much taxes." And that's what he had done. He took that $100,000 and he put it in an annuity. Okay. And he says, when I'm done, when I retire, I give everything to my kids and I'll be retiring, that then I could be taking the money. I mean, he will be in the lower tax bracket and he will be able to take that money, you know, plus the interest. And I don't know, I don't think the word hiding it, the funds, is the proper word to use it, but that's kind of what he did because he was in such a high tax bracket right now.
Okay. So a strategy that's becoming increasingly popular is to use the annuity to provide guaranteed income streams as a hedge against return risk from other assets. In other words, if you have some money in some more volatile types of investments, and you're drawing on those for your income, you might want to use an annuity to diversify, is what it amounts to. Excuse me, the allergies and the pollen is starting to affect me. So people are using it as a hedge against return risk from other assets. They're also, I'm sorry, I went too fast. They're also using it, annuities, to be able to, and we didn't talk about this when we talked about Social Security. If you get to your normal retirement age, which might be 66, 67, and you wait until age 70, every month, every year that you wait, your monthly income from Social Security goes up. And it goes up by 8%, which is a pretty good jump. I want to be clear about that 8%. When you get to 67 and they say this is what your income is per month, the 8% increase is based on what your age 67 income was. It's not a cumulative 8%. So as you go through age 68, you're going to get 8% higher. Age 69, you're going to get 8% on that original age 67 amount. So it's not really 8% of last year, it's 8% of age 67. Okay, so again, it's become guaranteed against return risks from other assets, but also you can use annuity money to provide income between the time you want to retire, age 65, and then you can wait till age 70 to take your Social Security and maximize your Social Security payment. Again, the financial strength of your insurance company is important. We compared favorably to the aggregate averages of the top 25 life insurance companies, and that's a good thing. Okay, we got a little time left here. Traditional IRAs versus Roth IRAs. And Roth IRAs have become very, very popular. One of the reasons is that people think, and Yola talked about just now about lower income tax bracket later on. And a lot of people now are talking about the fact that now it's really not, probably won't be a lower income tax. I just had a conversation with a young man who said, I'm using a traditional IRA. And I said, okay, well, your income, your deductions are tax deductible, and you're only at like a 12 to 15% income tax bracket. Why don't you pay the tax on the money, put it into a Roth IRA, then when you get out to age 65 or whenever you retire, you don't have to pay income tax on it, and you're in a 24 to 30% tax bracket. So it actually is an advantage to not pay the taxes later on and to pay them now. So with a traditional IRA, you get deductible contributions. With the Roth IRA, you don't. But that may not be such a bad thing, especially for younger people. There is a limit on contributions of $6,000. And actually, you can split these contributions. You can do $3,000 here and $3,000 here. Excuse me, unless you're over age 50, you can put in another $1,000. Tax deferred growth, yes and yes. And you'll see I'm not talking about traditional IRA non-deductible. It's because I don't see any reason for anybody to ever do that. But that's just me. Tax deferred growth, yes. Tax-free distributions, no. This one's fully taxable. This one is yes if qualified distribution. Qualified means that you got to wait 5 years before you start taking it out. Age limits, no. It used to be that you could no longer put money into an IRA after age 70 and a half. Now it's as long as you have earned income, you can put money into an IRA, whether it be the traditional or the Roth. Income limits, no. Here we have a contribution that's phased out if your gross income exceeds a specified limit. This limit is always in effect. Down here, you have an income limit also. Minimum distribution requirement. Yes, distributions must begin by age 72. So although they're looking right now at raising that to age 75, and quite honestly, I hope they do. So that would be good for me and some of my friends. So anyway, the Roth IRA, you don't have to start taking the money out. You can leave it there if you want to. Okay, bankruptcy protection. Original owner, yes, up to $1.3 million. Yes, up to $1.3 million. And there is no such thing as inherited IRAs anymore. So that used to be a nice tax dodge, but they took that away from us. So eligibility for a traditional IRA, single person can contribute the lesser of $6,000 or 100% of earned income. Married couple can go $6,000, but if you have a spouse that doesn't make any money, you can contribute another $6,000. So you can go up to $12,000. If you're older than 50, you can contribute an additional $1,000, so it's $7,000 instead of $6,000. IRA contributions are fully deductible. Okay, unless you and your spouse are active participants in a sponsored retirement program, like a 401k. If you have a 401k at work, you're out of luck in terms of an IRA. Okay, adjusted gross income here again. Maximum IRA deductions, joint taxpayer, single taxpayer, 66,000 and under. And as you can see, the IRA doesn't phase out until 115,000, 125,000 and above. There are no contributions that you can make. Okay. Oh, here again, the spouse of an active participant in an employer-sponsored retirement program who is not covered by his or her own plan can make a fully deductible contribution. So if I've got a 401k at work and my wife does not, she can make a contribution to the IRA. An IRA can be established and contributions made between January 1st of the current tax year and up to April 15th of the following year. This year, they extended it to May 17th. Last year, it was all the way out to July. Taxation. During lifetime contributions, you deduct. The growth is accumulated tax-free until distributed, so it's tax deferred also. Distributions are fully taxable. Premature distributions would have a 10% penalty. And then minimum distributions have to begin at age 72. I'm going through this a little bit quickly. These slides are available to you. If you would like a copy, just let us know. Estate taxation, the value of the IRA is included, and the actually kind of interesting here, traditional IRA distributions received by a beneficiary after the traditional owner's death are taxed in the same manner as if received by the owner. Again, that's the traditional IRA. If it were a Roth IRA, they wouldn't be taxed because there's no tax due from the owner. Roth IRA eligibility, single taxpayers up to $125,000, married up to $198,000. Those over age 50 can contribute an additional $1,000. The contribution amount is gradually reduced to zero for income levels between 125 and 140,000 and 208,000 for couples. You can make contributions to a Roth IRA even after age 70 and a half. Contributions, as we mentioned before, non-deductible. Distributions, qualified distributions. In other words, you have to wait 5 years before. Distribution must occur more than 5 years after the individual first contributed. The individual must be at least 59.5 years old. And there's no tax on that. Okay. And now, if you convert from a traditional to a Roth IRA, you have to pay income tax on the traditional IRA. And we haven't talked about conversions yet, but that I will in just a second. During a lifetime, contributions not tax deductible. The growth is tax deferred. Distributions are received free of income tax and are not subject to the 10% withdrawal penalty tax. No required distributions. So here we go with adjusted income. Distribution made within 5 years of the first Roth IRA contribution, and this is after 5 years. So earnings taxable, yes. Subject to 10% penalty, no. After the 5 years, earnings taxable, no. Subject to 10%, no. You know what? I'm not going to go through this right at the moment. I'm kind of running out of time, but we can send copies of it to you. Like I said, if you'd like a copy of this, we will be more than happy to send it to you. At death, estate taxation is included. The value is included in the estate. With the IRA, distributions received by the beneficiary are taxed in the same manner as if received by the owner. So they are taxed. You can do a transfer from a traditional IRA to a Roth IRA. And again, you would do this if you think your income tax is going to be higher at retirement than it is right now. And that's the advantage to doing it. Lots of people did it to begin with. It tailed off for a while, and now they're starting to look at that again. Can funds be transferred from a Roth IRA to a traditional? No, funds cannot be moved from a Roth IRA to a traditional, but they can be moved from a traditional to a Roth. Advantages, qualified distributions from a Roth are received free of income tax. If non-qualified distributions are taken, the portion of distribution represented by the traditional IRA is not taxable. There's no minimum age by which you must begin receiving distributions. Premature distribution penalty does not apply to amounts converted or rollover from a traditional IRA, so that is an advantage. And qualified distributions from an IRA are not included in determining the taxable portion of any Social Security benefits being received. Disadvantages, the amount that's converted or rolled over is subject to federal income tax in the year of conversion. This taxable income can serve to increase the taxable portion of Social Security benefits. And the premature distribution penalty applies to any converted or rolled over amounts. So here is a big one. You should seek professional tax advice before converting or rolling over funds from a traditional IRA to a Roth IRA. We are not accountants. We are not CPAs, although some of you may be, but we're not attorneys, and we don't give legal advice. And if we're doing something that has to do with taxes, we want to make sure that there is a professional giving tax advice. Okay, I went through it kind of quickly. There was a lot of material in there. Like I said, these are PowerPoints are available to you if you'd like them. If anybody have any questions at this point?
Please make sure to unmute yourself.
Yes, okay. Can you send me the PowerPoint's presentation, please?
Yes,
we will.
And
thank you.
No problem, no problem. I think we could, if there's no questions, we had that gentleman in the morning that had asked We had a gentleman in the morning that had a couple of questions in respect to if our annuities are tied to Standard and Poor, you know, to the market, to and the.
Oh, he wanted to know if it was tied to an index.
Yes, to an index.
And
exactly.
there are what's called indexed annuities, and our annuities, PNA annuities, are not indexed. It's a declared interest rate, and as I mentioned before, the executive committee gets together and determines what the rate's going to be. Indexed annuities are based on what an index does, and like a Standard and Poor's is an index, and you can buy an annuity that is indexed to Standard and Poor's or some other index that is used. So that's a little more volatile because you are tied to the index. It's a little more volatile than the mutual insurance company, which PNA is a mutual insurance company.
Also, his other question from the morning, his other question was if we as agents should offer annuities to individuals 30, 40 and younger. He was like, what's your opinion on that? He asked us.
Yeah, and the answer is if I were going to offer an annuity to somebody that's a younger age, I'd certainly look at a Roth IRA first, because usually those folks are in a lower income tax bracket, and they're going to be in a higher income tax bracket when they retire. And I'm just looking at the way things are going with our regulators and our legislators. They're always looking for more revenue, and I think the income tax is here to stay, and I'm not sure they're here to stay at the level they're at right now. So I would look at a Roth IRA for a younger person, but there's also ways of putting money into a life insurance policy for retirement, and we're going to be talking about that more as we go along, using money that's accumulated in a life insurance policy for retirement. So, any more questions, Yola?
I'm sorry. I'm sorry.
Okay. All right. Well, thank you so much for your time today, and thank you for your attention. We appreciate what you do out in the field. And if you have any questions or comments, we are more than happy to hear those. And if you would like a copy of the PowerPoint, Irene, we got your request, but if anybody else,
very much.
Okay, if anybody else would like a copy, just email us, or we'll get it to you as quickly as possible. So, okay, thank you.
Thank you.
Have a good rest of your day.
Thank you.
Thank you. I think stop sharing first.
Thank you.
Thank you. You guys enjoy your day and evening.
Same to you, the rest of your day.
Thank you.
Bye-bye.
Bye-bye.
Have a great evening. Thanks a lot for all the information.
Thank you.
Our pleasure.
Because go to stop sharing. That red one. And now end.